Hello everyone, let's start our today's discussion. I hope you all remember that in our previous class, we started our discussion on official mock exam issued by ACCA for September 2025 exam attempt for Advanced Taxation exam. In our previous class, we completed our discussion on question number 1. In our today's class, we'll be moving forward and we will be looking at question number 2 of this exam paper. Along with the discussion of this question, we will also be looking at the relevant rules through my summary notes, which is a life-saving document at the finalization phase of your exam preparation. In these summary notes, I have summarized the entire course of advanced taxation in just 57 pages. You can search any topic within these summary notes and that will be a great help for you guys. Like for example, if you want to refer rollover relief, you just write rollover and you will reach the relevant topic. So it's a great document and it will be really helpful for you guys in the finalization days of your examination. Now, in this series of past paper discussion sessions, we are looking at complete exam papers and we'll be doing around 7 complete attempt exam paper discussion in these recorded sessions. And that is really important to contribute in your chances to pass the examination because it gives you an idea that how you have to deal with a complete examination in which all of the topics are coming together, how you have to deal with a time restricted situation. So all of these things get clear when we do these discussion sessions. Once we are done with these 7 complete exam attempt papers, then we will be discussing 3 mock exams. I will be providing 3 mocks to you guys. You will be attempting them on your own and send me for marking and feedback. I'll be providing personalized feedback to all of you guys. So let's start with this question number 2. Okay, a very easy question, but obviously your patience and concentration will be really important. We'll first read this introduction, then this exhibit relating to Stephen, which is the only exhibit in this question. Then we'll be looking at the requirement tab. And then at last, we will be actually drafting the answer in these response options like the word processor and the spreadsheet. So all of these things, that how you have to deal with a complete exam paper, how you have to deal with the response options, each and everything will be covered in our today's class. So let's start with the reading of the introduction. When you are reading the question for the first time, it's very important that you read it with patience and concentration. Every question is easy. It is all about how you approach the question, how you understand it, how you deal with the data. Let's look at it. You should assume that today's date is 3rd September 2025. Stephen has requested advice in respect of the inheritance tax payable following the death of Stephen's father and the assets which should be sold in order to raise sufficient funds to purchase a holiday home. It is an introduction. The examiner is giving an overview what he's expecting from us. He's asking something about the IHT rules and then some disposal of assets. The following exhibit available on the left hand side of the screen provides information relevant to the question. This exhibit Stephen, which we'll be looking now. Exhibit 1 Stephen. The information should be used to answer the question requirement within your chosen response option. There are 2 response options. It is your choice that how you have to use them. So how to deal with these response options and everything, we will be looking when we will be actually drafting the answer in our today's class. So let's start the reading of this exhibit, and that's very important. Stephen's father, Mark, died on 17th June 2025. Stephen's father has never been married and has never a civil partner. In his will, he left a third of his estate to Stephen and a third to each of the Stephen's 2 brothers, Ian and John. So basically, Stephen's father, Mark, when Mark died, he divided his death estate in 3 parts. 1/3 to Stephen, 1/3 to his brother Ian, and 1/3 to his brother John. So he divided his estate in 3 parts. He had never been married nor had a civil partner. He has 3 children, Stephen, Ian, and John. Let's read. Estimated IHT position. Stephen has very little knowledge of the UK tax system, but has tried to estimate the IHT which will be payable in respect of his father's estate. Value of home in UK, excluding the value of contents and personal chattels. Just the value of home. The value of home in UK is £400,000. Value of the house in the country of Geost, £150,000. Less inheritance tax payable in Geost. See, this is an error. If any IHT was paid in other country, it is not deductible from the value of asset. That should be deductible from the IHT value. This 15,000 should be deducted from 206,000, which is the value after 40%. See, when you have an overseas asset, you have two deductions available. One is in relation of cost to sell that asset, not the tax, the cost, like administration cost, any legal fees or something like that. If there is any cost in relation to the asset, that is deductible here. And if there is any overseas tax paid, that becomes adjustable in form of double taxation relief, and that is deducted from the value of tax, not from the value of asset. Sir, can you show us the relevant rules? Yes, just go to the summary notes and write overseas IHT. Okay, now here you are in overseas IHT rules. In overseas IHT rules, on overseas assets, two reliefs are available. Transaction cost is deductible from value of asset. Transaction cost. Now, transaction cost can be cost to sell an asset, any agent commission, any legal fees, things like that. And another is double taxation relief. That is against the tax you have paid in overseas. That is deductible from the amount of IHT. See, one is transaction cost, like the legal fees, administration cost, agent commission, transaction cost. That is deductible from the value of asset. But any tax paid in overseas is not deductible from the value of asset. Rather, it is deductible from the value of IHT. Sir, what difference will it make? Here you are deducting from asset value, which is the total 100%. Here you will deduct from the IHT value, which is the 40% portion. Okay. So the overseas tax paid is deductible from the UK IHT amount, not from the value of asset. Then 23,000 shares in KIST Limited. Then cash in bank accounts. That gives you total debt state less nil rate band. Here there is also one mistake. He has ignored the residence NRB, this value of home. Since all of the things are given to children, Stephen is son of Mark. Mark gave assets to Stephen, his son, and two of his brothers, Ian and John. So the home is being given to direct descendant. So when a house is given to direct descendant, you have to consider residence NRB also. So he has missed out the impact of residence NRB. So he has tried to estimate. So you will have to pick up the mistakes. Notes. There is no double tax treaty between UK and the country of Geost. When there is no double tax treaty, you get standard double tax relief. See, this is the point every time a student get confused. Double tax treaty, double tax relief. These are two different things. Treaty means an agreement between two countries. If there will be a double tax treaty, then double taxation relief will be according to the treaty. The treaty, the agreement will state that how the relief has to be given. Maybe one country will take tax, other will not take. Whatever the treaty states. But if there is no double tax treaty, then there is standard double tax relief. And that standard double tax relief is lower of two things. If there is no double tax treaty, the DTR will be lower of two things, the UK tax and the overseas tax. See, this treaty thing confuses the student, and examiner every time gives this issue. The valuation of properties and shares are correct. Stephen's father, Mark, acquired shares in KIST Limited on 1st November 19. Here we don't know that whether it is a quoted company or unquoted company, because maybe business property relief is available, because these shares were acquired in November 19 and he is dying on June 25. So normally shares attract business property relief. If these are unquoted company shares, they will attract 100% BPR. If it is quoted company shares in which there was control, then it will attract 50% business property relief. So we don't know that whether the shares are quoted or unquoted. We'll look at it. Stephen's father's lifetime gift. Mark only made three gifts during his life. June 17, a cash gift of £120,000. March 19, a cash gift of £140,000. August 21, a cash gift of £165,000. We'll look at all of these things in detail. Stephen, sale of assets in order to raise additional funds to purchase a holiday home. Stephen intends to sell one or more of a vase, an antique ring, and 1 hectare of land out of 3 hectares. He wishes to raise as much money as possible without becoming subject to capital gain tax. Stephen must make these sales by 31st December 25 in order to acquire the property that he wants. Vase. Market value is 7,000, the cost was 12,000. So this means that vase is in a loss. It will be sold in a loss. Antique ring. Market value 4,200, cost 1,500. Since disposal proceed and cost are below 6,000, both are below 6,000. So this antique ring is an exempt asset. This antique ring is an exempt asset. DP and cost both below 6,000. Land. 1 hectare, 2 hectare, 3 hectare, the market value of all of them and the cost. He wants to sell 1 hectare out of the 3 hectares. Now if you look at it, the value of 1 hectare of land is £9,000. You can have a point in your mind about small part disposal. Why? Because it is a part disposal. He is disposing 1 hectare out of 3 hectares and the value of 1 hectare is less than £20,000. If you just go to your notes, write small part disposal. Land and building, proceed less than 20,000. All land and building disposed during the year cheaper than 20,000. And proceed should be less than 20%. We'll look at all of these things. We have just read the question for the first time now. Stephen is a higher rate taxpayer, resident and domiciled in UK. Stephen is unmarried, uses his annual exemption for the tax year 25-26 already. So this means that annual exemption is not available additionally for the capital gain tax purpose. So this is the total data given in the question. Okay. I feel that it's an easy one because I can predict that what will be asked. But in actual also the question is easy. You just need to listen to me carefully. You should assume that today's date is 3rd September 2025. Part A. 1 mark. A starter. A toffee. Explain whether or not there will be inheritance tax payable in respect of a cash gift to Stephen of £165,000. Here you can see cash gift to Stephen of £165,000. Will there be any IHT payable in respect of it? Now use your mind. Stephen's father Mark died on 17th June 2025. So if I go back 7 years, you go back 7 years from the death date to identify the chargeable transfers. If you go back 7 years from 17 June 2025, it will be 17th June 2018. Okay, 19, 20, 21, 22, 23, 24 and 25. If you minus 7 years from 2025, it will be 2018. Now 17th June 2018 to 17 June 25, that is your chargeable period. This means that this transfer and this transfer is chargeable. The gift of IN is not a chargeable transfer of 2017. Sir, why are you referring that? Because we need to think that whether there will be dead tax on it or not. So yes, this 2021 transfer will be subject to dead tax, but it will be covered in nil rate band. Okay, nil rate band will be used due to the transfer of 140,000 only. See, the gift to IN was not a chargeable transfer. It was a PAT during life. And in death also it was not chargeable because it do not lie within 7 years of the gift. Within seven years of the death. Within 7 years of death, there are only 2 gifts, 2019 and 2021. These are the chargeable ones. 2019 one will use NRB by 140,000. So 325 minus 140, you will still have 185,000 available in nil rate band. Okay. Even if I ignore annual exemptions, you will have 185,000 available in nil rate band, and that will cover this gift of 165,000. It will be covered in the nil rate band of death. Okay. Since nil rate band of death will only be used by gift of John, that gift value is of 140,000. Gift of Ian is not chargeable for death. Okay, let's look at it. When I will write it, I will repeat the things again also. But obviously, you need to listen to me very carefully to understand the things in a better manner. Okay, so the question is, Stephen, just listen to me carefully. Now, let's pick up the first requirement which we are dealing in, just a 1 marks requirement. We copy it from here and here we go. So this is our requirement. How many marks? 1 marks. See, since it's just a 1 mark requirement, so make sure that you just write with a perspective of 1 mark. Cash gift to Stephen will not be subject to any inheritance tax, as at the time of gift during life it was not subject to IST, because it is a potentially exempt transfer. At the time of death, at the time of Mark's death, on when did Mark died? Mark died on 17 June 25. At the time of Mark's death, on 17 June 2025, this cash gift of Stephen, of what is the date of cash gift to Stephen? That is of 11th August 2021. Cash gift of Stephen of this cash gift of Stephen of 11th August 2021 will be subject to death tax as it lies within 7 years of death. However, it will be covered in death tax nil rate band, as NRB will be available even after adjusting another or other chargeable gift of Mark of how much? Of 140,000 made to John. Of 140,000 pounds made to John on what date? On 18th March 2019. Of 18th March 2019. Sir, can you repeat it again? See, still I have written greater for 1 mark. You should have kept it more brief. Like if you would have just stated that cash gift of Stephen will not be subject to any IHT because it will be covered under death tax NRB. That was also sufficient for 1 mark. I have written a bit greater because while you are watching the lectures, you can understand it in a better manner. Let me repeat it again. Cash gift to Stephen will not be subject to any IHT as at the time of gift. Okay, as at the time of gift during life, it was not subject to IHT because it is a potentially exempt transfer. It was a lifetime gift. At the time of Mark's death on 17 June 25, this cash gift of Stephen, okay, on 11th August 2021, he died in 25. So these two gifts will be chargeable for death tax 2019 and 21. 2017 gift will not be subject to death tax. Do remember, because it do not lies in 7 years of death. So these only two were chargeable. So when you are calculating death tax on it, 325,000 minus this gift of 140, even when you will adjust the annual exemption, it will be less than 140. It will be like 137,000. Okay, if 1 year exemption is available, then also the NRB was available, will be subject to death tax as it lies within 7 years of death. However, it will be covered in death tax nil rate band, as NRB will be available even after adjusting other chargeable gift of Mark of 140,000 pounds made to John on 18th March 2019. So there will be no IHT. No IHT during life and no IHT at death also, because it will be covered in the nil rate band. Is it clear? So whether there will be IST, there will be no IST, no IST at the time of gift and no IST at the time of death because it will be covered in the nil rate band. A very easy requirement just for 1 mark. Now, part B. Believe me, it's a very easy question. For copying, you can use the Control C, but sometimes that function do not work, so you have to copy it manually. Okay, here I go. For paste, you can use Control V. Now, let's look at it, what he's saying. Part B1, which is a requirement for 5 marks. Since in question number 2 and 3, there are no marks for communication skill. So, you have to keep your answers very easy and straightforward. Just copy the requirement and discuss the answer. Explain with supporting calculations the corrections which need to be made to the IST computation prepared by Stephen. The corrections. And part 2, explain the additional information in order to finalize the computation. Read this note for this whole part B. You do not have sufficient information to recalculate the IST due in respect of marks state. So please do not attempt to do so. See, you just need to explain the corrections. You are not required to recalculate the entire IST again. Just discuss the corrections and then in part 2, the additional information which is required. Okay, let's look at the corrections. Obviously, here your professional skill of skepticism, questioning the calculation which has been done, that will be very important. Believe me, very easy. Just look at this calculation and question it, the concerns. First of all, 10% IST payable in GIOST is adjusted from the value of asset. That is wrong. It is not adjustable against the value of asset. Rather, it is deductible from the IST amount. Okay. Now, in IST calculation done by Stephen, he has deducted IST paid in GIOST from value of asset from value of house in GIOST while making the IST calculation of UK. This is wrong, as IST paid in other country is not deductible from value of asset. Rather, it will be relieved through double taxation relief from the amount of UK IST at lower of UK tax on overseas asset and tax paid in overseas country. Okay. See, the IST which was paid against this asset, he has deducted that IST paid from the value of house. That is wrong. It should not be deducted from the value of house. Okay, it should be deducted from the final IST payable. It cannot be deducted from here. This has been done wrongly. This is the wrong treatment. It shouldn't be the way it has to be dealt with. Okay. Okay. So now when you look at the debt state further, what you can see is that in relation to nil rate band, there is some important considerations which you need to consider. He has not included the residence NRB. Okay, see here there is a correction. Then 23,000 shares in the Quest Limited. So for that you will see that we need additional information for the BPR thing. That is the additional information we require. Looking at this, you will not say that it is a correction. That is the additional info we need. Now at nil rate band, yes, there are corrections. He has not included the residence NRB. Okay. Number 2. In the nil rate band, he has to deduct the chargeable transfers. He has not adjusted the chargeable transfers. These chargeable transfers, that is very important. He has missed out these chargeable transfers from it. You don't get the whole NRB while doing the IST calculation. So let's look at it. Stephen has missed residence NRB in his death state calculations. Okay, in death state of Mark, mean residence worth 400,000 is included. Worth 400,000 is included, and that is being transferred to his sons. Okay, and therefore, as a result, residence NRB of 175,000 pounds should be available because mean residence is being given to direct descendants. Okay, see, in the death state, there is this mean residence, their home of 400,000, which is being given to children. So, residence NRB of 175,000 should be available. Now, when you look at this nil rate band, see, there are some corrections. This NRB shouldn't be 325. You have to include residence NRB. You have to deduct the chargeable transfers of last 7 years. This 15,000 shouldn't be here. So, what about BPR? For that, we need additional information. Looking at this, we don't know about that correction. We don't know that whether it's unquoted or quoted. There were two requirements. One is, if you look at it, one requirement is the corrections. That what are the corrections which are required. And another is the additional information. Okay, now coming back. Further, Stephen has failed to adjust last 7 years chargeable transfers from the nil rate band he has included in Mark's death state. Okay, corrected value of nil rate band that should be adjusted in Mark's death state should be, now listen to me carefully, what should be the corrected value of the nil rate band? That you can do completely, you can solve that. That what should be the corrected value. I am not calculating the IST on the death state, however, I am correcting this nil rate band, that what value should come here. Okay, nil rate band, or you can say death year nil rate band, that was 325,000. From here you deduct last 7 years chargeable transfers. So now when you look at the chargeable transfers of Mark, the gifts he has made. So he had 3 gifts, June 17, March 19 and August 21. This June 17 gift is not a chargeable transfer because it do not lies within 7 years of death. See, the death is in June 25. So you go back till June 18. This gift do not lies within 7 years of death. This March 19 and August 21 gift lies within 7 years of death, and they will use up the nil rate band. Just listen to me. Okay. Last 7 year chargeable transfer. Now I will make a note 1 here. Note 1. Chargeable, or you can say transfers made by Mark during his life include 3 gifts which he made to his children. Okay. Gift made to IN in 2017 will not be subject to IHT on death, and it will not be a chargeable transfer as it do not lie within 7 years of death in 2025. Okay, because if you go back 7 years from 2025, it will be 2018. So the gift made to IN is not a chargeable transfer and it will not use up the nil rate band. Gift made to John and gift made to Stephen are the chargeable transfers and they will reduce the NRB. Gifts made to John, gift made to John in 2019 and gift made to Stephen in 2021 are chargeable transfers and they will reduce death tax NRB for death estate. because they lie within 7 years of gift. The death is in 2025. Okay, gift made to John in 2019 and gift made to Stephen in 2021 are chargeable transfers. Okay, as they lie within 7 years of death of 2025, and they will reduce the death tax NRB for death state. Now, gift made to John in 2019 has a chargeable value of how much? Has a chargeable value of how much? You made gift made to John in March 19. So March 19 is tax year of 1819. The tax year changes on 31st of March and to be exact on 5th of April. So March 19, please listen to me carefully. March 19 is tax year of 1819. Tax year before that 1718. In the previous year, there was a gift. So the previous year annual exemption is not available. Only current year annual exemption will be available. Listen with patience, I will repeat the things. Gift made to John on 18th March 2019 has a chargeable value of how much? 140,000 pounds minus 3,000 pounds annual exemption of 1819 of 2018-19. So it has a chargeable value of 137,000. Okay. Previous year annual exemption of 2017-18 will not be available as it will be used against gift to IN. See, even though gift of IN is not chargeable for death tax, but still it will use nil rate band. Now you need to remember your IST. When you do your lifetime taxes, you pick up each of the lifetime gift, value of transfer less annual exemption, you get the value of PAT or CLT. That gets locked up. So, this gift of 2017, 1718, it must have used the annual exemption of 1718. In the next year, 1819, March 19 is 1819, not 1920. March 19 is before April. You have 1819 annual exemption. You have annual exemption available of 1819, but previous year 1718 annual exemption was already used. Okay, so the chargeable value was 137,000. Then gift made to Stephen in August 2021, I believe. In August 2021, 11th August 21 of 165,000. On 11th August 2021 has a chargeable value of 165,000 minus 3,000 minus 3,000. 2 times 3,000. Why? August 21, 21, 22. Previous year, 2021. You have annual exemption of both years available. Because before August 21, there was no gift in the previous year. I will repeat it again also. Has chargeable value of 159,000. Annual exemption of both current year 2021-22 and of previous year of 2020-21 were available as no other gifts were made in these years. Sir, can you repeat it? See, August 21 is 21-22. Go back 1 year. 2021. There were no gifts in these years. Only previous gift was in 2019. So, here the chargeable value is 159 and one chargeable value is 137. 137,000 and 159,000. So, this will give you your available nil rate band. 325 minus 137 minus 159. So that is 29,000. Then you will get residence NRB 175,000. So total NRB for death state will be 204,000. Sir, will you repeat it again? Yes, I will repeat. Even though it is not difficult, it is something which a skills module student can also do. But still, let's repeat it. In IST calculation, he deducted the IST paid from the value of asset. That is wrong. It is not deducted from the value of asset. It has to be deducted from the final IST value. Okay. Then, for this 23,000 shares, we need additional information about BPR we don't know. So that is not a correction currently. Cash in bank account, nil rate band, there were mistakes in it. He missed out residence NRB. Home was being given to children, so residence NRB should be included. And then he failed to adjust the last 7-year chargeable transfers. He failed to adjust the last 7-year chargeable transfer. That is very important. And that is what we can do in the available data also. I haven't done the entire IST calculation again, but I have shown that what is the total NRB available. These are the corrections which is needed. Death year NRB, last 7-year chargeable transfers. 2017 transfer is not chargeable because it do not lies in 7 years of gift. 19 and 21 transfers are chargeable. 19 transfer 137,000, 2021 transfer chargeable value 159,000. Looking at the annual exemptions and dates, I believe this is not something which should be difficult. Okay, like August 21, 21-22 and previous year 2021, you have exemptions of both year. March 2019, 18-19, you have the annual exemption, but previous year 17-18 already used. Even though the transfer is not chargeable, but it will use up the annual exemption. Okay, now if you come back here, the next thing he has asked, which is very much related to it, explain any additional information which you need. Explain any additional information which you need in order to finalize these computations. So there are some additional information which we need. Like what? You need additional information like against this value of house, was there any transaction cost? Because if there will be any transaction cost, that will be deductible from here. If there will be any transaction cost, that will be deductible from here. Okay, the actual cost and the 5% of the value of asset. You need information about the business property relief. Okay, what do you mean by business property relief? That whether these shares are quoted or unquoted. So what additional information you need in order to finalize these computations? Okay, let's look at it. Okay, so in relation to the additional information is required in relation to any cost to sell incurred against the overseas asset of house in, what was the country? Of house in Giost. Of house in Giost. Okay, any cost to sell incurred will be deductible against the value of asset included in death state for IST calculation of UK at lower of what? Lower of actual cost incurred and 5% of value of asset, which will be 150,000 pounds, as copying the pound sign, 150,000 pounds multiplied by 5%, so that will be 2,500 pounds, if I'm not wrong. 150,000 into 5%, 7,500 pounds. Okay, so since the value of asset is 150,000, so that you need to consider. You also need to think about the domicile status of mark. We don't know, because when there is overseas asset included, overseas assets are only subject to UK IST when someone is UK domicile holder. Okay. Further, information about domicile status of Mark is also required, as his death estate includes an overseas asset of Giost. Okay. overseas asset will only be subject to UK IHT if Mark is a UK domicile holder. Okay, if he is not a UK domicile holder, then only UK assets will be subject to UK IHT. Okay, within evaluation of his UK domicile, consideration need to be given to his actual domicile status and also to situations of deemed domicile status if he do not hold actual domicile of UK. Okay, see what additional things you require. Okay, deemed domicile status may require information about his years spent in UK, about his years of residency in UK, and details about his place of birth and domicile of origin. See, what further you need? Overseas assets only become subject to UK IHT when you are UK domicile holder. Okay, when you are a UK domicile holder, then only overseas assets become subject to UK IHT. Now, within evaluation of UK domicile, consideration need to be given to his actual domicile status and also to the situations of deemed domicile status if you do not hold actual domicile. If you have actual domicile, okay, that's okay. Actual domicile is your legal status. But if you don't have actual domicile, there are situations of deemed domicile also for the UK IHT. Okay, that require your years of residency, that requires your birth, where you were born, whether you had domicile of origin or not, and all of these things. Further, as we discussed multiple times, for these shares in Quist Limited, you need information about the BPR thing, whether it's a quoted company, whether it's an unquoted company. Okay, then what are the assets included in Quist Limited? Trading assets, accepted assets. I believe it was easy. First, we identified mistakes that it shouldn't be here. Residence NRB and NRB adjustment issue, chargeable transfer and all. Then additional information. In relation to shares of Quist Limited, information about the company's quoted and unquoted status will be required to evaluate business property relief. Okay, shareholding in company has already completed 2 years, therefore BPR eligibility exists. If it is an unquoted company, then 100% BPR will be available. However, if it is a quoted company, then 50% BPR will be available if control exists in this company. Like Mark has the controlling shares in the company. Okay. Further, in relation to BPR, details about assets in Quist Limited will also be required. That what are the value of accepted assets in it, as that portion will not be eligible for BPR. Okay, what are the value of accepted assets? Accepted assets are those which you are not using in the business. Now, if you simply go to the summary notes and you search business property relief, BPR, 100% on unquoted shares, 50% on quoted shares if donor has control, 2-year holding requirement, that was already satisfied because these shares were purchased in 2019. Okay, then no BPR on the accepted asset portion. Okay. If there are accepted assets within the company, accepted assets means which you are not using in the business. Okay. So I believe that if you remember the relevant rules, it was an easy one. The first requirement of 1 mark was also very easy. Then identifying the corrections and then the additional information which was required here. Done. Let's move forward. So now we are done with 12 marks. Looking at part C now. Explain with supporting calculation which assets Stephen should sell in order to achieve his objective. If you remember, the Stephen's objective was to generate maximum funds from the company without creating the CGT liability. Okay, so let's look at it. We'll read the relevant exhibit part again and then we'll look at it. So this is of 6 marks and then we have one last requirement of 2 marks. Okay, let's look at this and finalize this question. Okay, so now we are looking at this part C, in which we have to discuss that explain with supporting calculation which assets Stephen should sell in order to achieve his objectives. Now, if you go and look at the details of Stephen's sale of assets, Stephen intends to sell one or more of a vase, an antique ring, 1 hectare out of 3 hectare field. He wishes to raise as much money as possible without becoming subject to capital gain tax. Stephen must make these sales by 31st December 2025 in order to acquire the property he wants. Now, if Stephen will sell this vase, there will be no capital gain tax on it because its market value is 7,000 whereas its cost is 12,000. So it will be sold at a loss. Let's go step by step. Okay. If Stephen will sell the vase, there will be no capital gain tax on its disposal as it will be sold at a loss. Okay. Its cost was how much? Its cost was 12,000 pounds. Okay. Let me copy the pound sign. Its cost was 12,000 pounds, whereas it will be sold for 7,000 pounds. Its cost was 12,000 pounds, whereas its market value is 7,000 pounds. It will be sold at a loss of 5,000 pounds. So there will be no capital gain tax on disposal of this vase because it will be sold at a loss. CGT arises when there is a gain. Okay. Then in relation to the antique ring, it is an exempt asset as its disposal proceed and cost both are below 6,000 pounds. Further, in relation to antique ring, there will be no capital gain tax on it as it is an exempt asset. Okay, it is a chattel whose cost and disposal proceed both are below 6,000 pounds. So it is an exempt asset. Now let's look in relation to that 1 hectare of the land. Now if you look at 1 hectare of land, it is a situation of part disposal because you are selling it as part of that 3 hectare field. Now you need to think that whether small part disposal will be available through which the gain gets deferred. So if you look at it, this 9,000 is less than 20,000 pounds. There is no other disposal of land and building during there. He is only selling this 1 hectare. And what is the percentage? This 9,000 divided by 50,000. So this is 18%. If disposal proceed is less than 20%, then you can get a deferral through small part disposal. If you remember, asset must be land and building, proceed should be less than 20,000. All land and building disposed during the proceed should be less than 20,000. Here there is no other disposal of land and building, and proceed of the part should be less than 20% of the total value of asset. Further, in relation or lastly in relation to sale of 1 hectare of land out of 3 hectare field, there will be no immediate capital gain tax as Stephen can defer his gain through small part disposal in relation to it. Okay, small part disposal relief will be available as all of the following conditions will be satisfied in relation to sale. Okay, sale of 1 hectare of land. 1 hectare of land is a sale of land. Okay, land and building is included in small part disposal. Its disposal proceed is 9,000 pounds, which is less than 20,000 pounds limit. Okay, there is no other disposal of land and building during the year such that total proceeds of disposal of land and building is of this 1 hectare only, which is 9,000 pounds, and that is less than 20,000. That total land and buildings disposed during the year, that disposal proceed should be less than 20,000. So there is no other disposal of any other land and building. Lastly, disposal proceed of 1 hectare of 9,000 pounds is 18% of total value of land. This is less than 20% limit for small part disposal relief. Okay, how did we get 18%? 9,000 pounds divided by total value, that is 50,000, multiplied by 100. The value of all 3 hectares is 50,000 pounds. Okay, due to small part disposal relief, gain on sale of this part of land that is 1 hectare will be deferred till disposal of remaining land. This is what small part disposal relief do. This means that Stephen can sell all of the 3 assets as planned without creating or without having any CGT liability. He can generate total proceeds of how much? 7,000 pounds from vase, 7,000 of the vase, okay, because the market value of vase was 7,000. Okay, then from the ring 4,200, and from 1 hectare 9,000, plus 4,200 from the ring plus 9,000 pounds from land. So that total will be 7,000, 4,200 and 9,000. So that is 20,200 pounds. I believe it was not difficult one. It was all about just remembering the basic rules. If Stephen will sell the vase, there will be no capital gain tax as it is getting sold at loss. Antique ring was exempt as that cost and disposal proceed both were below 6,000. In relation to sale of 1 hectare of land, he will get small part disposal relief because it was selling a part of land from the total field, and all of the conditions of small part disposal were satisfied. So how did your mind went for small part disposal? First of all, it was disposal of a part, 1 hectare of a 3 hectare field. And then when I looked at the disposal proceed of 9,000, which is less than 20,000, my mind started to working that, okay, I should think about a situation when small part disposal relief may be available. Okay. Now, a last, only 2 marks requirement. Explain with supporting calculation whether or not your advice would be different if Stephen were prepared to pay a small amount of capital gain tax. See, earlier Stephen was saying that I don't want to pay any tax without becoming subject to tax. Now he is willing to pay small amount of tax. So, will there be any change in the advice? Let's think about it. See, even if he is willing to pay any tax, this vase has no tax on it. This ring has no tax on it. Only situation will be that on this 1 hectare of land he can have a tax. Okay. If Stephen is willing to pay small amount of tax, then he may select to disapply small part disposal on sale of 1 hectare of land and make that gain chargeable now. Okay. In that case, his capital gain tax will be, what will be his capital gain tax in that case? Let's look at it. Okay. I want you all to listen to me carefully. Disposal proceed of 1 hectare of land. Just listen to me carefully. 9,000 pounds. Disposal proceed of 1 hectare of land is 9,000 pounds. Just listen. Cost of disposed part or cost of 1 hectare of land. Now see, you can look at the scenario. He never purchased 1 hectare of land separately. It was a 3 hectare field which was purchased and its cost was 17,000. So you need to allocate the cost. You need to allocate the cost. Okay. So now what will be the cost of disposed part? If you look at it, 17,000 was the cost of all 3 hectares multiplied by disposal proceed 9,000 divided by disposal proceed plus market value of remaining. I hope you all remember the workings of the part disposal. Disposal proceed divided by disposal proceed plus market value of remaining. The remaining had a market value of 30,000 pounds. Okay. Plus 30,000 pounds. So that gives me 17,000 multiplied by disposal proceed 9,000 divided by disposal proceed plus market value of remaining. So that gives me cost of disposed part of 3923. 3923. Now what will be my chargeable gain here? Now I am not deferring it. I will make the gain chargeable now. 9,000 minus 3923. That gives me 5077. Now if you look carefully, he has a capital loss of VAS which he can use here. Capital loss of VAS. See, obviously you can offset that loss of VAS also here. If you remember that loss of 5,000 pounds, he has that capital loss. Ring was exempt, but on VAS you had a loss. So if you deduct that 5,000, then his gain will be 77 pounds only. The question clearly states that he has already used his annual exemption and he is a higher rate taxpayer. Okay, so now annual exemption is already used, and Stephen is a higher rate taxpayer. Therefore, capital gain tax will be 77 pounds into 20%. That will be a very small amount which he has to pay, and that will be 15 pounds only. Okay, so if Stephen is willing to pay small amount of CGT, it is better not to defer the gain, as in that case he can utilize his capital loss of VAS against disposal of 1 hectare of land. Okay, base cost of remaining land will not reduce in this case by gain element also, and that will not increase future disposal gain. Sir, can you repeat it again? Yes, I will repeat. Okay, just a second. Let me close this question first. I believe that it was not a difficult one. Now, so if you look at it carefully, see, if he's willing to pay small amount of tax is just 15 pounds. So it is better that he don't defer the gain. Because if you defer the gain, then what happened? Just think about it. If you defer the gain, then what happened is that you will deduct this complete 9,000 pounds from the base cost of the remaining land. So the base cost gets reduced. When the base cost gets reduced, automatically future gain will rise because the gain gets deferred. It do not gets exempted. Gain gets deferred. So if Stephen is willing to pay small amount of tax and that's only 15 pounds, it is better not to defer gain, as in that case he can utilize his capital loss of VAS against disposal of 1 hectare of land. Base cost of remaining land will not reduce in this case by gain element also. Base cost will reduce but by the cost of disposed part only, not by the gain element also. Okay, and that will not increase the further disposal gain whenever in future you will be disposing the remaining land. So if he is willing to pay a small amount of tax, then it's better that he don't defer the gain. Okay, so with this, yes, this question is done. So if you look at this question, I believe that it wasn't a difficult one. First, a very simple question in relation to nil rate ban, that the gift will be covered in NRB. Then identification of some mistakes in calculation. Then further information we require, additional information we need. Okay, so that we discussed. Okay, I believe it was also not difficult. Then explain with supporting calculation what assets Stephen can sell. That was very easy. That VAS was in loss, antique ring was exempt, 1 hectare of land can be deferred through small part disposal. And then lastly, we did the working that, okay, if we don't defer the gain and if we made it chargeable now, because that was the only possibility in which the gain can be chargeable now. Other things were not subject to IHT. So he has to pay a tax of only 15 pounds. So with this question number 2 is done. I believe that you guys have understood the concept and this class was beneficial for you. Now in the next class, we'll move forward and we'll be looking at question number 3 of this official mock exam. And so on, we'll be progressing, discussing a lot of past papers in this series of revision sessions so that you can have a more better idea that how you have to deal with the actual examination. Okay, thank you everyone and hope to see you all in the next class.